brought it out, though. Welcome in Ted Thatcher, our next guest, joining us, friend of the show, president at Bright Lake Wealth Management. Ted, great to have you on to kick off this new month of trading, although nearly entirely red big board right now as I'm looking at our major indices. But yet still, I'm saying record. I think we've notched a few more than a dozen since March. So how are you looking at this rally and how sustainable it is?
Yeah, Marley, I think coming into this weekend, investors were expecting positive headlines, probably pushing equity markets a little further, thinking about positive headlines with the war in Iran. Obviously, we got the opposite of that. We've seen oil spike this morning. We see the 10-year above 4.5, and still, like you said, a little bit of red, but really flat on the equity side. And so investors, I think, have really said, hey, there's not that much risk with the war in Iran, especially the last several weeks. And so we're trying to say, okay, how much risk is there here? Is the, pulling out of the ceasefire by Iran really going to be sustained? And so ultimately, we'll see that reflected in markets very quickly here. But right now, I think things are fairly stable, actually.
And as we look at the market, you described it in the notes that you sent over as being on cloud 9. Now, I'm not sure if you wrote that before or after this weekend. I'm also not sure that this weekend actually makes that much difference because it's not the first time we've priced in peace and not got it. But sentiment is improving. We've got a lot of chasing of momentum here. Take me through this cloud 9 and how long we can stay on cloud 9.
Sure, yeah. Since those March 30th lows, that's what I was referring to. We have had 9 successful weeks in a row in the markets. You mentioned the all-time highs. 17 times now the S&P 500 specifically has hit those highs. And so, ultimately, what has driven equity markets here? I think a lot of emphasis, of course, has been made on the AI constraints in the economy, that $750 billion that's constantly cited of CapEx driving into the memory layer and the data center build out. But I think, really importantly, it's not just, extension of AI CapEx kind of creating a bubble. In my view, so much of this really fundamentally has come back to earnings. We've seen the S&P 500, 84% of the companies report EPS beats, 25 to 28% increases in profits in Q1 of 2026. And so when you see that kind of momentum at the fundamental level, that's really what I think has driven this rally and why I think that we're not in this sort of bubble conversation, bubble territory here.
And part of your outlook was that we would hit new highs potentially in Q2. Obviously, that has come to fruition. But you highlight the potential that the third quarter could be tougher. We could be looking for a pullback. From your viewpoint, Ted, what is the biggest potential disruptive risk to this rally?
It's a really important question, Marley, because investors, of course, are always trying to price in where the risk is. And obviously, I think when I see a big rally, I think it's pretty natural to have a little cyclical, pullback, a healthy one. That I think really being driven by this inflation conversation and the potential that the 10-year Treasury stays above those, especially 4.5 level. That just makes the world a very, very, very expensive place for consumers. It's already been expensive with the price of gasoline now filtering into all the inflation metrics. We see PPI up at 6 handles. We see CPI and PCE at 3.8. When that starts to filter into those core numbers is where I become concerned. And so because of the pressure that's put on consumers, I do feel that there's a potential of that. And that's ultimately where I would say I see the most potential risk.
And do you have any other concerns about concentration? Because that's the only other thing that comes up when I get into these talks about what could derail us, that some people view that we're too heavily concentrated. Yes, we had an incredible earnings season. We saw margins expand at profit margins, record levels. We had, I think, more than 80% of companies beat in terms of the estimates. But are you concerned at all about the concentration around the AI narrative?
I think that it's been the leadership that's kind of taken us in a lot of ways through this rally. And so, sure, I think anytime you get over-concentrated, naturally investors are going to have a little bit of hesitation. But do I think it is an alarm bell ringing? I don't as much, and I think it is because of the earnings that we see on the back end. The huge leadership name like NVIDIA, still depending on, exactly how you look at the numbers, between 14 and 17 times forward earnings. Some of the many, huge headlines around on Micron, still trading into single-digit forward earnings look. We could talk about other memory stocks as well. But, is there a concentration there? Yes, of course. Do I think it's going to be a house of cards? Not necessarily, although I do think, again, there's a potential for a little bit of a pullback before we see, further gains.
And you mentioned the consumer, too, as is the other big risk here. Now, we know we've got inflation yet again outpacing wage growth. We know that we have consumer sentiment near all-time lows, but we've also got this slew of retail earnings that every single one came across the board and said the consumer is still spending, the consumer is resilient. Yes, we had words like cautious and deal hunting, but they are still spending. So what are you trusting? What signals are you viewing with the most importance? Because it is a bit confusing when we put it all together.
Yeah, I think it kind of tells me that the K-shaped discussion, the narrative, is back front and center. I will say this, though. When we think about the consumer, and to your point, I think we have to come down to their behavior. Consumers may feel and say that, they're concerned, the sentiment's down, well noted. But when you see people are still going out, still shopping, still, going out to eat, restaurants and things like that, ultimately we have to look at consumer behavior. And when you pair that behavior with the earnings that we've seen, it's hard to say that the consumer isn't still, operating in the economy. Obviously, things are tight, inflation is up, and I think that those things can't be discounted. If you look a little bit under the hood on some of those, retail numbers and who is spending, of course, it's really important to remember in that K-shaped discussion, essentially the top 10% of earners are actually the ones that are qualifying for effectively 50% of the spending. And so with that sort of power law still at play, it does have me a little bit concerned for that low end on the K, of course, that we've discussed and has been discussed so much in the last 12 months.
So with that backdrop, Ted, where are you putting fresh money to work right now? Where do you see the most opportunity?
The way I look at this, Marley, when we think about investors, again, always thinking about return and then risk and obviously what the objectives are in between. When we see a rally like this, rarely do investors want to go, heavy with a new bet when you do see run-ups. So I think it's important for investors to think about entry points as well as position size within their portfolio. That said, I think it's really a good thing to own leadership and the leaders in this market, specifically NVIDIA and Google. Again, I kind of mentioned their forward earnings, NVIDIA specifically, between 14 and 17 times forward. Jensen's been out in the media saying, hey, we deserve basically a much higher valuation. Of course, they're fighting the fact that they're the most highly valued company in the world. But if you look to the future and you start to take a little bit of a longer term view, 3 and 5 years out, I believe both NVIDIA and Alphabet are $10 trillion names. You see these huge companies kind of get re-rated at times. And so I would expect, that to continue to happen to NVIDIA over time. Interestingly, of course, they had all these beats coming out of their Q1 earnings reports, and they almost kind of lost a little bit of value for it. Again, I think that they will eventually be re-rated here. And then, of course, on the Alphabet side, so much have they been rewarded for their full stack advantage, their TPUs, their Gemini, of course, model. And then I think most importantly, Marley, their distribution. And I only think that that's going to continue to grow in terms of the moat and the value they get from that.
All right, and I know you also like some other AI plays, AMD, Micron, IREN here. Later in the show, we're having a memory conversation, so you may want to stick around to hear some perspectives, because I know there's one that's going to stick out to you, Ted. But really appreciate you being with us today to take us through your picks and also for a broader look at the markets. Ted Thatcher, president over at Bright Lake Wealth Management.